Most Australians think a $5 million net worth means a big house, a nice car, and a fat super balance. That's not what wealthy families look like. The ones who actually keep $5 million and turn it into $10, $20, $50 million over time don't hold their money the way you do. They hold it in a structure, a specific structure, and once you see it, you can't unsee it. So today, I'm going to show you exactly what a $5 million Australian family office looks like. Every entity, every dollar, every decision. By the end of this video, you'll know more about how rich Australians actually build wealth than 99% of the people in this country, and I'll show you the exact moment most families cross the line where this structure starts paying for itself, usually a lot earlier than you'd think. Quick note before we dive in. This video was recorded based on the tax rules and thresholds in place before the most recent federal budget. The government has flagged a number of changes to super, to trust taxation, and to thresholds, some of which are legislated, some of which are still proposals working their way through Parliament. The structure I'm about to show you still works. The principles don't change with a budget, but some of the specific numbers, tax rates, thresholds, caps, will shift over the next 12 to 18 months as legislation passes. So treat the figures in this video as directional, not precise, and always get advice tailored to your situation before acting on anything. Before we get into it, let me tell you why this matters. The difference between holding $5 million the right way and the wrong way isn't small. It's not a few $1,000s a year. It's somewhere between $80,000 and $100,000 every single year in additional after-tax cash flow. Reinvested over 20 years, that's $3 to $5 million in extra wealth without earning a single extra dollar. The wealthy families you see in Australia, the ones with the harbour view homes, the second properties in Noosa, the kids who somehow seem to start their adult lives already wealthy, they're not earning more than the professional couple next door. They're structured better. That's it. That's the entire game. And by the end of this video, you'll see exactly how it works. Here's what most Aussie families with $5 million net worth actually look like. The family home worth maybe $2.5 million in their personal names. A couple of investment properties also in personal names, negatively geared. A share portfolio of maybe $400,000 sitting in a ComSec account, also in personal names, and $1.5 million in super, split between two spouses. Sounds reasonable, right? It's the standard Australian wealth building playbook, the one your parents told you about, the one your accountant signs off on, the one every personal finance book in this country recommends, and it's wrong. This structure is a disaster. Why? Because every dollar of income above $190,000 is taxed at the top marginal rate of 47 cents in the dollar. Every capital gain on those investment properties is taxed at the top marginal rate. The assets are exposed to lawsuits, divorce, and bankruptcy. The kids can't be brought into the wealth gradually. And when mum and dad eventually pass away, there's a massive tax event waiting for the family. This is what I call accidental wealth. Wealth that happens despite the structure, not because of it. Now let me show you what a real $5 million Australian family office looks like. Same $5 million in assets, completely different structure, completely different outcomes. There are 5 layers to this structure, and I'm going to walk you through every single one. Pay attention to layer 3 especially, because that's the one most middle-class Aussies have never heard of, and it's the single biggest driver of long-term wealth in this country. By the time we're done, you'll see exactly how rich Australian families turn the same income everyone else earns into 2 to 3 times more wealth. Let's start at the top, the operating company. This is the engine of the whole structure. If the family runs a business, and most $5 million families have a business of some kind, whether it's a medical practice, a trades company, a consulting firm, a small manufacturing operation, or a property development outfit, the business sits inside a Pty Ltd company. Why a company? 2 reasons. First, tax. Companies in Australia pay a flat 25% tax rate if they're a base rate entity, or 30% if they're not. Compare that to 47% personal tax at the top marginal rate. That's already a 22 cent in the dollar saving on every dollar earned inside the company. On $500,000 of business profit, that's $110,000 a year in tax savings every year. Second, protection. Companies have limited liability. If the business gets sued, and businesses do get sued more often than people realize, the company is the legal target, not the family, personally. But here's the critical part most people miss. The operating company doesn't own anything valuable. No buildings, no equipment, no intellectual property, no goodwill that's been built up over years. Why? Because if the business gets sued for negligence, breach of contract, or wrongful dismissal, you don't want the family's wealth in the firing line. The operating company runs the business, generates profit, pays its tax at 25%, and then pays everything left over upward to its shareholder. It's deliberately set up to be hollow. That's a feature, not a bug. The shareholder of the operating company isn't a person. It's a family trust. Specifically, a discretionary trust with a corporate trustee. And this is where the structure starts getting clever. A discretionary trust doesn't pay tax itself. Read that again, the trust pays no tax. Instead, it distributes its income to beneficiaries, usually family members, and they pay tax at their own marginal rates. Why does that matter? Because it gives the family enormous flexibility. Say dad is on the top marginal rate of 47%. The trust can distribute income to mum instead, who might be on a lower rate, or to adult children at university who have the tax-free threshold of $18,200 and can receive distributions tax-free up to that level. Or, and this is the move most accountants miss and where the real wealth is built, to a corporate beneficiary, which caps the tax at 30%. We'll come back to that in a minute. The trust can also hold the family's passive investments, share portfolios, private equity holdings, anything that isn't the operating business sits inside the trust. Why? Because trusts allow you to stream different types of income, dividends, capital gains, rent, to different beneficiaries each year, depending on who needs what. It's the most flexible wealth structure in Australian law. And because the trust legally owns these assets, not the family personally, they're protected from personal lawsuits. If dad gets sued personally, the trust assets aren't his. If one of the adult kids has a messy divorce, the trust assets aren't theirs. The family controls the trust through the trustee company and a critical role called the appointer, the person who can hire and fire the trustee. They benefit from it, but they don't own it. That distinction, control without ownership, is the heart of how wealthy families protect their wealth across generations. Now here's where most Australian families fall behind, the bucket company. This is the single most underused wealth building tool in this country. A bucket company, sometimes called a corporate beneficiary, is a PTY Ltd company that exists for one purpose: to receive distributions from the family trust and hold them at the 30% company tax rate. Think about what that means. Instead of distributing $200,000 of trust income to dad at 47%, losing $94,000 to tax, the trust distributes it to the bucket company at 30%. Tax bill, $60,000, saving $34,000. In 1 year, from one income stream, and that's the small example. Wealthy families are running this play across multiple income streams, dividends, capital gains, rent, business profit, and saving six figures every single year. But the tax saving is only half the story. Here's the part most people miss. That money inside the bucket company doesn't just sit there. It gets reinvested into shares, into ETFs, into commercial property, even loaned back to the family trust to fund new investments. The bucket company becomes a long-term compounding vehicle. And when the family eventually wants to spend that money, maybe in retirement, maybe to fund a child's first home, maybe to take a sabbatical, the bucket company pays them franked dividends, which means the shareholder gets a credit for the 30% tax already paid. If they're now in a lower tax bracket, they can actually get a refund of some of that tax. This is how wealthy Australian families turn their tax bill into investment capital. It's not magic, it's just a structure 95% of people don't know exists. Below the bucket company sits superannuation. For a $5 million family, this is almost always a self-managed super fund, an SMSF. The super fund holds mum and dad's retirement savings, and the tax rates inside super are extraordinary. 15% on earnings while in accumulation phase. Zero, literally zero in pension phase, up to the transfer balance cap, which is currently $2 million per person. Think about what that means. A couple can have up to $4 million in pension phase super, generating returns, paying zero tax on those returns. But the super fund can do more than just hold shares and term deposits. It can hold commercial property, it can hold business real property, which means the actual building the family business operates out of. And here's where the structure gets really powerful. The operating company can pay rent to the super fund for the building. That rent is fully deductible to the operating company at the 25% tax rate. The same rent is received by the super fund and taxed at just 15% in accumulation phase or zero in pension phase. That's a 10-cent arbitrage on every rental dollar, fully legal, and the ATO has signed off on it for decades. It's the most protected pool of wealth a family can legally build in Australia. Now, there are rules. The super fund has to be set up correctly. The property has to be acquired at arm's length. The rent has to be at market rates. But for any family with a business and meaningful super balances, this is one of the highest value moves in the entire structure. The final layer most $5 million families build is a private ancillary fund, a PAF. Most Australians have never heard of this, and it's one of the most powerful tools in the structure. A PAF is a charitable trust. Money goes in, the family gets an immediate tax deduction at their marginal rate. The money is then invested inside the PAF, and the investment returns are completely tax-free. The PAF distributes at least 5% per year to charities the family chooses. Now, why would a wealthy family do this? 4 reasons. First, timing. If the family has a huge tax event coming, say they sell a business or a major property, they can make a large PAF contribution in that year, get a massive deduction, and spread the actual charitable giving over decades. They control the tax timing. Second, compounding. Money inside the PAF grows tax-free forever. Compare that to giving money directly to charity each year. Once it's gone, it's gone. Inside a PAF, $1 million in contributions might generate $50,000 a year for charity for the next 50 years. Third, family governance. The PAF becomes a multi-generational charitable vehicle. The kids and grandkids join the board, choose which charities to support, learn about philanthropy, and develop a sense of stewardship over family wealth. This is the conversation that brings the next generation into the wealth structure without giving them money directly. Fourth, legacy. The family name is attached to charitable giving for generations. Most middle-class families have never heard of one. That gap tells you everything about how the wealth ladder actually works in this country. So let's put it all together. At the top, the operating company earning income at 25%. Below that, the family trust receiving the after-tax profits and distributing them strategically. Off to one side, the bucket company catching excess distributions at 30% and compounding them long term. On the other side, the SMSF growing retirement wealth at 15% or zero in pension phase. And alongside it all, the PAF, doing good and reducing the family's tax bill in high income years. This structure does 5 things at once. It minimizes tax, it protects assets, it enables income splitting across the family, it compounds capital efficiently, and it sets up the next generation to inherit not just wealth, but a framework for managing it. The family that holds $5 million this way will, on average, build wealth 2 to 3 times faster than the family that holds it in personal names. Not because they earn more, because they keep more, compound more, and lose less to friction. The structure is the strategy. Let me put a specific number on this. A family with $5 million held badly might generate $400,000 a year in pre-tax income across their assets. After personal name tax, accounting for the top marginal rate, Medicare levy, and Div 293 on super contributions, they keep maybe $230,000 to $240,000. A family with the same $5 million held in the structure I just described keeps somewhere between $310,000 and $330,000 of that same $400,000. That's $80,000 to $100,000 a year more every year, reinvested, compounding at a conservative 7% return over 20 years. The structure adds somewhere between $3 million and $5 million to the family's wealth without earning a single extra dollar, without taking a single extra risk. Let me say that another way. Two identical Australian families, same business, same income, same lifestyle, same investment returns. One uses this structure, the other doesn't. After 20 years, the structured family is $3 to $5 million ahead. After 30 years, that gap is closer to $8 to $12 million. After 2 generations, it's life-changing. The wealthy aren't smarter than you. They aren't luckier. They aren't more talented. They're structured better. That's the entire secret. That's the whole game. Now, obviously, building this structure isn't free. It costs somewhere between $5,000 and $15,000 to set up properly, depending on complexity, and it costs a few $1,000s a year in accounting and compliance to maintain, which is why it doesn't make sense for everyone. The break-even is usually around $1 million in investable assets or a business generating $200,000 a year or more in profit. Below that line, you're paying more in structure costs than you're saving in tax. Above that line, every year you delay building this structure costs you tens of thousands of dollars in extra tax and lost compounding. Most Australians cross that line earlier than they realise. The professional couple in their 40s with a paid-down mortgage, a growing super balance, and a side business doing $250,000 a year. They're already past it. They just don't know it yet. The tradies running a successful contracting business, they crossed it years ago. The medical specialists earning $400,000 to $600,000, they crossed it the day they finished training. If that's you, every year you wait is a year you're working for the tax office instead of for your family. That's the structure. If this was useful, hit the like button. It genuinely helps the channel reach more Australians who need to see this. Subscribe so you don't miss what's coming next, and drop a comment below telling me what topic you want me to break down.